seems like this is a very common path for a lot of real estate investors that succeed and scale their portfolio.
We got to a point where we bought 8-plex and 10-plex. Well, one JV partner is not going to be able to put in all the money. Put it this way, I've used corporate lawyer. So I've made all these kind of different mistakes, and now I look back like, I'm so glad I didn't get into trouble.
It's also the reason why it's so important that if we're going to do a GP-LP structure, that you're going through a securities lawyer, because the thing is, your lawyer may have great intentions. If they're your real estate lawyer, maybe they reach out to a partner that does some of them, they get the gist of it, but they're never going to have stick-handled any of these tough or sticky situations with a GP-LP.
We learned from RAIN, the Real Estate Investment Network, that this is the way to do it. They said this is the way to do it. So we learned that this is the way to do it. Okay, let's do it. So GP-LP now is getting a little bit, it's easy for me, for us, especially we've got a very strong team behind.
What is up, YouTube? Matt McKeever here, and we've got a special treat for you today. We've got Kasey and Jed on the channel. So you guys have wanted to see more Kasey Wong recently, and we've got a 2-for-1 Wong special with both Kasey and Jed. So I'm really excited. We cover some really high-level concepts here and dive deeper into some of the details that I think you guys have really wanted to see. So if you enjoy this video, let us know in the comment section down below. We're also going to link to Jed and Kasey's business and their contact information in the video description down below. So if you want to follow along with their corporate account, we really encourage you to do so. And if you're an accredited investor or interested in participating with them, their contact information is down below. Feel free to reach out. But hope you guys enjoyed this video. Smash the like button, hit subscribe, and let's get into it.
All right, YouTube, we're back with Jed and Kasey Wong. I'm really excited. I know you guys are excited just to hear more about how they're structuring their deals and some of their thoughts when it comes to, say, GP and LP structures versus JV structures. So one, really appreciate you guys coming on the channel to chat to us about this. And I guess before we jump into the different ways people can potentially structure a deal, do you guys mind giving them some context for where you're at right now with your portfolio and just how you guys currently approach this?
Right. Well, thanks for inviting us here. This is pretty much my first time. So currently what we have always been doing in the past, I would say 7 years now, is organizing GP and LP structure for every time we have a project together with the investors. We've also done JV in the past. This is prior, I would say around back in 2005, 6, around that time frame, we've done JV, and then later on, as we progressed and did bigger deals, we migrated into more formal GP LP structure, where a lot of the real estate projects are structured that way. Yeah, so each partnership is only for that particular project. We don't commingle different properties with different investors into one LP.
And so taking a step back, it seems like this is a very common path for a lot of real estate investors that succeed and scale their portfolio. They often start off with maybe their own capital. Then at some point in time, they tap that out. Then they turn to JV partners. At some point in time, they decide the JV structure is no longer appropriate for the type of deals they want to do. And then they seem to elevate or progress into often a GP-LP structure. Do you guys mind maybe just breaking down for us, when and why did you decide, Jed, that JV structures were no longer the right structure for you and the deals you guys were doing?
Yeah, so it brings me back to 2005. So up until then, so we started purchasing a whole bunch of properties with our own capital. And up until a certain point, we as you said, we ran out of capital. And then we started branching out to our family and friends. At that point, to make it a little bit easier to understand for someone who's first time for them, we suggest a JV, and because it's easy, compliance issue from the administration standpoint, it is quite simple, and technically there isn't a entity you have, because JV is essentially two parties getting together. They do their own separate books, they have their own separate accounting and all that, and all it is the property itself will generate one set of books, and then the JV partner will just take their portion. So back in the days, we were growing, we were just learning all that, soaking in all this new information. We learned from RAIN, Real Estate Investment Network, that it is this is the way to do it. They said this is the way to do it. So we learned that this is the way to do it. Okay, let's do it. So it was 50-50 to start off. It was okay for 1 or 2 deals. It was okay for a single family home, for maybe even up to just one simple property. We typically did use that structure for one single family homes.
Yeah.
But we continued to grow. We got to a point where we bought 8-plex and 10-plex. Well, one JV partner is not going to be able to put in all the money. And at that point, our network wasn't, they're not accredited investors. They probably, the capital that they put in, maybe 50,000, some of them even as low as 25,000, or even if it's 100,000, for them it's a big deal. And it's never a third party, it's always your family, right? So at that point, we thought, okay, that's not the most efficient way of raising capital and make other people comfortable as when they come into this investment, they need to feel, one, you guys know what you're talking about, and second is it legit, right? Is it legitimate? And what kind of documents you have that doesn't look Mickey Mouse, right? So at that point, being a CPA, I had a tax background. I thought, wait a second, this JV agreement from RAIN doesn't seem to be appropriate for bigger assets. And this is back in 2006. And then I thought, okay, there's only 2 other options. Actually, which is only, at that time I didn't know the GPLP, how complex it was. So I heard it was complex. So I kind of took that aside, right? So I was looking into it, let's form a corporation. Now, I knew the corporation is going to be a lot more administrative, compliance and all that, but at least it allows me to look like I'm more sophisticated, and I was raising more money from friends. They're not even family members now, so they're friends that trusted us that we know what we're doing. So we formed a corporation to buy this 20-unit, 8 and 12-unit building together. Shareholder agreement and all that, and it went well, right? The format went well.
Yeah.
The investment didn't, but the format went well. Yeah, that was in Hamilton, but we can go into it. But the downside was it was inflexible. So let's say from a tax standpoint, if there's losses, it's trapped in the corporation. There's really nothing you can do unless you amalgamate with another corporations that generate profit that you can use. You can amalgamate them and use the losses. But if you don't, then you're stuck. The losses are staying in the corporations, and in this case, it did stay in the corporation. And you also have at a compliance cost, you gotta file tax returns, and you have to create that corporation and file all these annual filings. So at the end of the day, yes, it gave it gave some credibility to us, knowing we know what to do, and then the investors also they were given a different set of class of shares, because again they're considered a non-voting passive investors. So another factor is about not efficient to use a corporation is that yes, you can assign a different class of shares, but when you want to divvy it up, you have to be very specific and spell out exactly what these various shareholders' responsibility and liabilities are. So it's not the greatest, and in fact, you don't see a whole lot of people using that if they are seriously into real estate, organizing real estate projects. So after that experience, we kind of, we had to regroup and we held on to our property. So we didn't really do a whole lot of stuff, a whole lot of projects other than keeping what we already had. And then fast forward to 2016, I was also more mature, I was more experienced, and at the time I was with Ernst & Young, I was actually in the asset management. One of my biggest client was Invesco. So I saw all the ins and outs behind, the fund, asset, how it works, asset management fund, what is mutual fund trust, and all of that. And also, I was more experienced in the GP-LP structure. And typically, that's what they do with private equity industry. It accomplished that limited liability, the benefit of that. It can achieve that benefit. It allows for flow through of income, expenses, and all that. And it gives the flexibility for the manager to exercise any, make decisions and exercise with their rights. So that's how. So when we put together our first GP-LP in Canada, I have done one in the States too. So in Canada, that was in 2016. I knew what I was doing, but knowing what you're doing is different from knowing who knows how to put these together. Mm-hmm. And typically, the corporate lawyers, they don't really know this. You have to go to a security lawyer. And now what happens to security lawyers is they're expensive, mm-hmm. super expensive. So if you're on a tight budget, you can cut corners and all that, but you really, put it this way, I've used corporate lawyer. So I've made all these kind of different mistakes. And now I look back like, I'm so glad I didn't get into trouble. But the fact is, you definitely we create a nominee, a number company. And that number company really has no asset except for holding legal title to the partnership. And I don't want to say anything bad about certain lawyers, but not every lawyer knows how to work with this structure. Mm-hmm. And you would think that real estate lawyers should know. Unfortunately, on our first deal in Duke and Wellington, the lawyer who closed it did not have any clue on what GP-LP was. So I literally it gave me a scare. It really gave me a scare, especially a day on closing, realizing that LP cannot hold the title. So those are the little things that you wouldn't know until you encounter or you hear people, who've done it and you learn from it. But the LP cannot hold a legal title. But the GP is the only one who does, but the LP has to come along and the name has to be on the land registry as a beneficial owner. So these are the things that the security lawyer will tell you, or they could assume that you know, because whoever goes to a security lawyer, they should have a certain level of sophistication in this type of deals. Recently, I've been asked, how do you put together GP-LP? It's a loaded question because, look, I'm not a security lawyer, but I know enough now, to say, okay, this is a very simple structure. You need a nominee and you need the LP. You go to register with the Ontario, what is it? The Ministry of, I can't remember the name, but you go to University 393 University and you register a limited partnership. You pay $210, you go register, and then this limited partnership will only last for 5 years. So that's the basic of it. But what then? Well, then you got to go to a lawyer and say, hey, I want to, we have to create an LP, so can you draft an LPA? the limited partnership agreement. Then they're going to ask you, what do you want to put in it?
Yeah.
That's the meat that you have to tell them. And they can only give you, this is what other people, like generally, this is what other people do. But at the end, you have to decide what is your responsibility as a GP, because it has to be spelled out in there. What is, how long is a project, and what is the purpose of the project, and how are you going to get compensated, and how's the distribution order, and all of that you really have to know what you need to put in it. And to come up with this decision, it's a lot of time, it's a management decision. Mm-hmm. So again, there's no, like I remember when we first put together the LP, I'm like asking, because it's not on the market, like no one comes out and spell out, this is how we charge, because every partnership is different.
Yeah.
So I don't know if I talk too much, but this is essentially just the tip of the iceberg when people ask me how do you put together this? I'm like, I don't know what your deal is. Like, and if I do, it costs me a lot of time, and honestly, you do have to. We pay our lawyers a Miller Thompson. Mm-hmm. To get to Miller Thompson, I've gone through a lot of different revision and lawyers and all that. And my first LPA, it turned out to be a stud. Like, good that we didn't get into trouble. But now I look back, I'm like, wow, that's the problem of not spending that kind of money. Going through the corporate lawyer who doesn't really know the security law. But the Miller Thompson is like 30 grand. Mm-hmm. So, and each time too, like even if you think it's repeated, if you don't have that background of legalese and all that, you pay the same amount every single one of them, right? Mm-hmm. Like maybe 30 grand is not so much on a, $10 million deal or a 20, but it is a lot if you're talking about $600,000 deal. Mm-hmm. So, yeah.
Yeah, I really appreciate you breaking that down for us, Jed. That was kind of like, that there was a lot there to unpack, but a couple things that I really want to highlight is, one, I've definitely been there as well, those frustrations with the lawyers. We've got a couple, this is our mistake, but we've got a couple corporations that sound very similar, and we've literally accidentally closed in the wrong corporation once, where the lawyers, legal secretary put down Inc. instead of limited, and lesson learned there. But also, it is really important that people understand that when it comes to this GP-LP structure, one, I think a lot of people get shiny object syndrome, and they hear that, say, you guys do it, or maybe I do it with some of our stuff, and they immediately decide that they want to go do it just because we're doing it. And one, you have to have the end in mind, right? Like, you need to know exactly what you plan to do with this partnership in order to effectively set it up. So you can't just go and pay once and then have a generic GP-LP structure that you can go use indefinitely, especially like Jed said, if you don't have the expertise around understanding the nuances, because the devils are in the details of that actual agreement around the LP. And I know for us, we went through a securities lawyer, and even for the relatively simple GP-LP structure that we had set up, it ended up costing us about $15,000. And once we went through all that, we ended up realizing that actually, no, we were maybe going to be better served with a different solution. So again, it's important that people are taking the long-term view to this, right? And you need to make sure that it really is the right thing for what you're trying to accomplish. And if you're not positive about your business model, you should probably firm up the business model first, rather than like me, go spend 15 grand, then firm up your business model and decide, actually, we're going to pivot and go in a different direction here. But to summarize overall, when it comes to kind of the evolution of buying personally versus joint ventures and then into the GP-LP structure, it seems like for a lot of people at first, they just want to try and cost minimize, right? So naturally, they're going to go buy personally because it gets you the cheapest mortgages, it gets you the fastest, you get 100% equity, all that stuff. Then once we tap that out, we're kind of attracted to JV structures because we can often borrow someone else's JV agreement, right? And we cross out a couple names, we tweak a few things, and we're like, I think this will work out, and we're able to go do that. Or maybe you pay a random lawyer $1,000 for a boiler template agreement.
Yeah, so one thing I learned from that, I was very cost conscious. Mm-hmm. So I guess after all these years, I'm still cost conscious, but when it comes to legal documents, I think I'm willing to spend a bit more money. It's because I realize it's easier to go and dig deep and spend the money and cover off a lot of the contentious issues. And clarify what happens when this situation happens. Because that's what security lawyers do, right? They tell you all that. Then say after the fact, when everything goes sour, and then someone, your let's say your partner, your joint venture partner, or your investors come to say, go through the agreement and said, hey, you didn't do this, so now I'm going to sue you. Or send you a letter, explain to me, Or if you have investors that you want to kick out, because just be real, right? There's some people who you just don't want to deal with again, right? So those investors, how can you get them out? So all of that comes down to the black and white words, not so much, oh, you're my friends. Like at that point, there's no friends. It's either what is on the agreement. What did you sign? What did you agree? And all of that. We recently had a incident. So there's a couple of investors that we wanted to part ways. And the rest of them stayed back, and also we felt it would be beneficial for us to carry on the project without those couple of investors. How do we get rid of them, right? So it goes back to, this is our very first LP, and because I didn't spend the money, we have to pick through what section in the LPA we can use to get them out.
It's because information wasn't provided to us, and it really delayed the financing. So it sounds like we're just kicking investors out. But when she's actually Jed's very surface leveled in a way that she doesn't want to go delve deep into it, but it really hindered the project in itself. When you have, let's say, 5 investors, 2 of them is not helping us and delaying the process and not providing certain information, and we can't get financing, and now we're delaying everything because of these 2 investors. So that's sort of the details to what she's going at. She didn't want to delve deep into it. But
so at the end of the day, we felt it would be a disservice to other investors if we kept these 2 behind with us. So then what happened? Well, the only way, because the LP was drafted in it was very convoluted, the way we could terminate that investment or that relationship with the investors. But we were able to find one thing that we can use. So we said it, you know what, this is under this clause, this section, this clause, we are no longer inviting you. Basically, we're terminating your subscription. And then 2 months, about a month or 2 later, I got a letter from their lawyer and say, explain to us what kind of disadvantage or hardship or financially, legally, or anything that my client caused to the partnership. Man, so we eventually resolved that issue. But the fact is, you don't need all of those heartache and potential legal, and because it takes time away from your regular work. That's why when I look back, I wished I could have spent a bit more and not cheap out on legal, but you wouldn't know what you don't know what you don't know, right? You bump into the wall and I'm like, crap, I got hurt. So next time you make sure the wall is softer. You're gonna encounter different, these different problems, but I don't talk about these in public much, just, these are the battles that we fight, right? But yeah, I wouldn't cheap out on legal.
Yeah, I definitely appreciate that context because, again, I see so many investors are tempted by that idea, but very similarly to your point there, that if you haven't bumped into that hard wall, you don't know it's hard. It's also the reason why it's so important that if we're going to do a GPLP structure, that you're going through a securities lawyer, because the thing is, your lawyer may have great intentions. If they're your real estate lawyer, maybe they reach out to a partner that does some of them, they get the gist of it, but they're never going to have stick handled any of these tough or sticky situations with a GPLP. So they won't know the details that you need to put in, like, oh, okay, if things go sideways on this real estate deal, I've had other clients, I've seen how it went sideways, it went this way. So we'll put this clause or this condition or this aspect into the agreement, and it's going to protect everyone because now I understand, because your lawyer's been through it before. And that's why paying for that experience is even more important at the start, because we know nothing at the start when we move into these new domains.
Yeah, I also have done something in the States as well. So that's a completely different ballgame, but let's leave that because that's very complicated. Now we're moving into, so GPLP now is getting a little bit, it's easy for me, for us, especially we've got a very strong team behind that reads these legal stuff day in, day out, and we can actually replicate what we have done in previously, change some wordings, distribution and all that, and apply the same thing, because we kind of perfected our LPA. But again, we're moving into new territory too, right? So we're moving into a trust and a REIT structure. So that's another thing. So this time we're paying big bucks. Like we have Stikeman to be our lawyer. We've got MMP to be our tax advisors. But the thing is, these are the guys that work on, you know, the big guys stuff. So they see all the pitfalls and all the things that you have to put in these trust agreement, because now it's, you know, it's a bigger deal. You don't want to have this Mickey Mouse legal flowing around. And don't forget, you need a subscription agreement as well. So it's always subscription agreement, and that to us, so we have 40-page subscription agreement, and we have 40 somewhat pages in LPA. So these 80 somewhat pages, you know, I would read through them and don't fall asleep, because truly they are very hard, like they are all legalese, right? But it's very important to have these two go hand in hand.
Awesome. Yeah, I really appreciate you guys kind of breaking it down for us. I know we could probably spend an entire lifetime trying to get deeper into the nuances between a GP and LP. Again, we're really just even viewing it through the lens of for real estate investments, right? You can use this for a variety of business purposes. Obviously, you guys do need to go get your own tax and legal professionals if you're going to dive into this world. But if you're going to take one thing away from this video, hopefully you take away, don't be cheap when it comes to hiring those power team members, because really the devil's in the details, and we're hiring these people to take care of the details for us, because when you're starting off new, trust me, you don't know all the details. Really appreciate it, Jed and Kasey.
Thanks again to Jed and Kasey for taking the time to shoot this video. Again, I think it's unlike anything else you're going to find on the Canadian YouTube. So if you got value from it, the way you can let us know is smashing the like button, adding a comment in the comment section down below, and sharing is caring when it comes to social media. So please share this, LinkedIn, Facebook, Twitter, wherever you'd like to share it. We would really appreciate it, and maybe even encourage us to make more videos like this. Thanks, guys.